We are now in Chapter 7 with one more week to go. And I just want to say that I appreciate all your diligence and hard work. I know 8 weeks is difficult to get through because it's a lot going on, but I've tried to be sensitive to that and not overload you. So I hope you appreciate that, but I hope you also are enjoying what you're learning and in the process, okay? I'm really trying to get faster at doing these PowerPoints. I didn't mean for the ones to go long, but there's a lot to cover. So I'm going to probably be a little more succinct, and I'm just experimenting a little bit with just different ways to be able to engage. I know most people appreciate the PowerPoints and going through lectures this way, so that's why I use them. But I have to consider how if I want to continue this. I really try and keep them to 30 minutes or less, but it hasn't worked out that way for a while. So let me see how I can do today. All right. Okay. So Chapter 7 really focuses on some of the challenges that are faced when dealing with poor countries versus rich countries, which we looked at in Chapter 6. And so with this, there's a lot of things that are confronted when we talk about the various challenges, and that's what we're going to look at today, are those challenges. So without further ado, so first of all, when we talk about disparities in wealth and the growing concern, there is obviously lots of conferences and forums that deal with looking at all the various statistical data and also all the international connections with corporations, multinationals, financial institutions, non-governmental organizations, and intergovernmental organizations, and how they all work collectively together to sort of develop the global economy and make it work for all countries. At least that's what they say. Now, whether they actually do that, that's another question. But certainly, in terms of looking at disparities in wealth, there are a couple things that really have to be taken into account. Of course, you have to accommodate multiple interests and perspectives across the wealth gap between rich and poor. Also, we know that today that income inequality is growing, and that is of great concern. In other words, the rich are getting richer and the poor are getting poorer. And the question is really why, and what, if anything, can be done to really address it or deal with it. And so they have these forums to try and discuss the ideas behind what causes the failure of the economic model that further erodes the global South from being able to stand on its own. And so there's a lot of anti-globalization movement where these grievances are aired out. And then they also talk about alternatives to the free market economy, the laissez-faire economy that many feel it has created the problem of economic and social development. Here's a example of the wealth gap that you can see. So if you look at the chart here, on your left are those who make $1 million plus. You can see their share of the wealth is about 45%. That 0.4 is actually 40%, so about 45%. And the percentage of adults that make more than $1 million is about 10%. And then from 100,000 up to $1 million, you can see there that the wealth they share is about, again, almost about 40%. And the percentage of adults that make between 100,000 and $1 million is about 10%. The next column over, you can see that from those who make 10,000 up to 100,000, their share of the wealth is about a little over about 12 to 15%, and the percentage of adults is about 30%. And then for those who make under $10,000, their share of the wealth is almost negligible, as you can see, and the percentage of adults who reside in this are probably upward of 60%. So you can see that there's a huge disparity in the wealth gap, especially when you get into the 10,000 and under, but but also even within the 10,000 to 100,000 range. And this is where the problem resides. So when we talk about this, the idea regarding neoliberals, basically deals with the rules administered by largely governmental and business entities that have great leverage on the global economy. And the rules restrict developing countries from making decisions that will affect their own well-being. So this is where we see a big part of the problem. Also, the idea of globalization, the globalization debate. In advanced industrial countries, we found that there was a lot of resistance to the adjustments required to really operate in an open market system, because if it's benefiting the rich, then why would they want to change it, right? There's also an outsourcing of jobs, which has powered a lot of opposition. Of course, there has been allegations of manipulations of trade rules and currency values to enhance competitiveness, which has also been of concern. And then, of course, there are supporters of globalization that point to the likely benefits of preserving open markets, which spread capital and other resources to areas that have need. And some of the opponents focus on the cost to workers and those without the requisite skills to operate in those environments. And so when you talk about shaping the future of the world economy, then decisions about trade, investment, and finance will shape probably a lot of what happens with the future of the world economy, and also the willingness of governments to address their differences to take prior to taking retaliatory action to determine the character and structure of international trade. Of course, one of the things when we talk about dealing with the expansion of trade has a lot to do with incentives. And when you look at incentives, you're talking about things like technology and how technology has contributed to the growth, and the idea of like these massive container ships that carry cargo. So in other words, instead of having small containers, they have these gigantic ones that basically reduce the unit cost of transportation. It also deals with the capacity of the ships. In recent years, those capacities have doubled in size, and the facilities at ports are enhanced to accommodate these like gigantic vessels. If you're ever up in LA, you can go to Long Beach Harbor or San Pedro, and you'll see these unbelievably just like gigantic mega ships. And so with that, so the benefits of importing and exporting goods certainly drives the economy, and the exports generate income and employment, and the imports, of course, enhance the quality of life, at least supposedly, by providing consumers with, of course, a wider range of products. And then, of course, protectionism is government policies that restrict imports in an effort to shield local businesses from global competition. This is usually what you'll see in the form of tariffs. I remember when the Japanese cars are really popular and much better condition and actually more efficient than American cars back in the 80s and 90s. And so in the U.S., they placed tariffs on the Japanese cars, which means basically a car that, let's say, was $20,000 would then cost you $25,000 or $30,000 to try and get people to buy American cars, even though they were pretty junky back then. And so, but what happened was people just paid the extra $5,000 or $10,000 and bought the Japanese cars anyway. So it didn't really pan out well. But some of the drawbacks to protectionism, of course, focus on the issue of that you can have responses that threaten vital economic relationships. And an example of that would be like the U.S.-China trade wars. That would be the U.S. looked to eliminate the cost advantage Chinese steel had over an aluminum product and aluminum imports, and then China focused on limiting sales of soybeans and other products of importance to the American farmers. Overall, the level of trade declined, and preliminary agreements to lower tensions was reached, but it was a blowback from the protectionism philosophy. And then we look at countries that are how they're ranked regarding active traders. The top, of course, United States is the most active, and then Germany, and then followed by other advanced industrial countries. Some, like most of the European countries, of course. China's probably in that mix, Russia and other places as well. China is the largest exporter, and then you have other countries that are also becoming more active in their trade. So, like for example, Mexico, India, and Brazil have become much more active as they try to rise from the lower or poorer countries into more developed and with developing economies. And in recent years, we've seen Russia, though, their trade has declined a little bit, and it's because they're so heavily relied on the energy trade, and that's been a really losing business for them recently, and also the decline in oil and gas prices. So those have been a couple of things that have caused them to have some problems. And then when we talk about the global trade system and some of the challenges, of course, and there are plenty of them, to say the least. But some of the challenges include, so for example, many of the global South, they have basically complained about the fact of the inherent unfairness in terms of trade that have left them really marginalized. They try to push for preferential treatment to level the playing field and improve their competitiveness. But so far they've been blocked by the global north or those wealthier countries that control primarily the global economy. Of course, the impact of trade on the global economy. Basically, trade has risen steadily for many years, and the only dip in that would have been when the 2008-2009 financial meltdown of not only the U.S. economy but the global economy, and that was the steepest decline they had seen in almost 70 years. Other aspects that we focus on here deal with difficulties in maintaining cooperative trade relationships. And this basically has a lot to do with the pressure to be at home to build domestic capacity and create more jobs. So this is, when you're trying to stay competitive, and like in the United States where the wages are higher than in countries like Mexico and other places, then the ability to your money gap between what your profit gap is diminished, because that's why we outsource so much to other countries, because we can use the workers there for a fraction of the dollar of what it would cost to hire an American worker or build it here. But also by doing that, we're also preventing American workers from making decent wages. There's also some issues dealing with like the WTO, the World Trade Organization, which has handled nearly 600 complaints and issued over 300 rulings dealing with third world countries and also with a variety of trade issues. Guatemala, for example, had a claim against India that India provided excessive domestic support to producers of sugar and sugarcane. The European Union's opposition to Colombian duties applied to imports of frozen potatoes. So these are all aspects of what we find to be, how when you talk about trade, how does one get a tactical advantage to be able to sustain their economies. So philosophically, you can see as it talks about some of the various approaches. So first, certainly free trade emphasizes elimination of sort of institutional and informal barriers to maximize exchange of goods and services. That's the whole purpose of free trade. Open up the markets so that people can buy and sell at reasonable prices, stimulate economic growth for the greatest good for the greatest number of people. So these are just some of the philosophical aspects of approach to trade. Okay, uh, so with that, the trade policies are definitely sensitive to external and internal pressures, right? How goes the global economy certainly impacts the domestic economies of the world, especially imagine if you would the Titanic and then all the rest of it, like the United States being the Titanic and then the other countries being the dinghies on the side of the boat, right? That would be the sort of the analogy I would use. So when one's doing well, they're all doing well, and the impact uh, of an international entity like China or Russia would certainly have a dramatic impact. If the economy failed, would certainly have a tremendous impact on the United States, for example. Um, Certainly, in order to sort of everybody's looking out for their own self-interest, so they push trade policies that serve their own interests and needs of their countries or their regions that they come from, like the EU, for example. Uh, and then, of course, the idea of protectionism, meaning sustaining your own internal, infrastructure, certainly has gotten much more popular in the last 10 years. And then when we look at the backlash uh, to protectionism, there are certainly there are some disadvantages. For example, small farmers are victimized by the uncertainty of the commodity markets, and they also lose out when prices are low and are too far down in a chain that they don't even get a seat at the table when you talk about agribusiness and distributors who benefit when prices rise. So farmers really, unless they're corporate farms, really have taken a beating. During this period of time when you talk about free trade. And then let's see, what else do I want to talk about here? Oh, the Doha. Okay, so the Doha round, this is basically international trade negotiations that are conducted under the auspices of the WTO, the World Trade Organization, with multiple interests that are affected by trade policy, which makes it difficult to strike an acceptable balance. So the purpose of the Doha round was to reduce obstacles to trading while advancing a development agenda, which would focus mostly on the needs and concerns of the poorer countries. And then so again, as we continue on the idea of the protectionist backlash, um, there's been a lot of discussion regarding the rules that limit the diffusion of knowledge to the global south, which is really problematic because with respect to critical medicines and patents that are held by large pharmaceutical companies, things like that. And then the idea of the circumvention of the IPR rules, which, as you can see, focuses on the various disagreements over IPRs, counterfeiters or commonly infringe on the protections, and then which also can include anything from pirated software in Beijing, for example, or a pair of designer jeans that are made in Moscow, or watch that's made in a back alley in Cairo, for example. Um, these are just some of the things that are potentially can circumvent uh, the IPR rules. And then when we talk about the idea of regional integration, and here we're talking about discuss the promotion of the European Union, and the EU has led the way in promoting what we call regional integration, and the idea of development of a single market which seeks to maximize trade among members by promoting the free movement of goods within that bloc of countries. So the European Union and the countries that reside within it um, can promote their own well-being within the bloc of countries. So they serve each other's interests. And then you also have in region like free trade regions, like in Asia, the Association of Southeast Asian Nations and the APEC, the Asian Pacific Economic Cooperation have also enhanced their trade and investment linkages within their regions. And then in the Americas, it's also, since 1990s, the American government has used sort of regional compacts to build export-oriented development strategies to heighten global competition. And this includes, for example, in Argentina, Brazil, Paraguay, and Uruguay came together around 1990-91 to form the Common Market of the South. So there's been all these blocks of countries that have tried to control their own regional viability. And there's really, the premise of this was to sort of break down the dominant role of the U.S. that had controlled all these initiatives throughout history. And then we get to NAFTA. And NAFTA stands for the North America Free Trade Agreement. And of course, this is an arrangement that was designed to expand cross-border trade and investment, signed by the U.S., Canada, and Mexico in 1994. There was much opposition to the agreement when it was first signed, even prior to its signature. The United States workers feared a significant transfer of jobs across to Mexico. American environmental and labor rights groups also argued for stricter workplace standards. So there was a lot of issues regarding the displacement of domestic production, of production cuts of millions of others, and again, Mexico lost about 1.3 million farm jobs by lowering tariffs. And then the expansion of regional trade investment, that while NAFTA was in place, trade and investment flows across the region expanded considerably. From 1993 to 2017, trade among trading partners nearly quadrupled, from 294 billion to over $1 trillion. And the value of Mexico exports to the U.S. increased by almost 680%. So you can see there's a lot of advantage to these ideas of how this all works. Let's see. So USMAC, which also, again, this is a continuation of the free trade versus protectionism argument. It was a new accord that was signed by Canada, U.S., and Mexico that incorporates significant changes that address major concerns, and these changes include, for example, the provisions to narrow the wage differential between U.S. and Mexico auto workers, increase the percentage of domestic parts and automobiles required to qualify for tariff exemptions, etc. And then the opposition to free trade of the Americas, the FTAA. There was much opposition. Some of it had to do with there's been no subsequent effort to reopen formal discussions. Governments have proceeded to negotiate bilateral agreements with individual trade partners, which has created some blowback and opposition to the free trade areas of the Americas. Okay, let me move on to past the free trade protection. I think you've got this. Okay, so as we move on to discussing transnational investments, again, I'm not going to expect you to be the expert here. I just want to touch on a couple of things. And one particularly is just that the expansion of trade among industrial countries, which basically between 1991 and 2000, the trade among industrial countries expanded about 60%, but capital flows topped that, growing at almost 300%. Advances in transportation and telecommunications have made it easier for companies to manage operations abroad, and emerging new markets, market-oriented economies, and liberalization of financial markets have also contributed to expansion. And then direct investments, the acquisition of corporate assets through the purchase of property and plant or equipment have also increased. Okay. So under transnational corporations, these are, again, companies that are operating on a global scale, right? The top 500 global companies have about $33 trillion in revenues and employ nearly 70 million people. and represent about 30 countries. And of the world's 50 largest economic entities, 6 of them are transnational corporations. So you can see that, and even compared to some countries, these global companies can hold a huge amount of economic power over the rest of the world. 5 of the largest of these companies are petroleum and energy related companies. And the advantage of transnational corporations, in terms of their ability has a lot to do with their ability to generate employment and integrate developing countries into the global economy, basically by infusing capital and supplying jobs and transferring modern technology. And then also the transnational corporations invest, helping countries build some infrastructure and enhance their capacity for economic growth. And in China, in the last few years, China has surpassed the united U.S. economy. And of course, 175 or 176 of the top 500 firms were located in emerging or developing countries. And China alone accounts for 70% of the countries in this group. So about 35%, 70% of that 35% is all Chinese companies. Also, China's auto industry is starting to move. For example, Geely, one of the Chinese major auto industry manufacturers, purchased Volvo, which is a Swedish car, for about just under $2 billion, which was from Ford Motor Corporation. So the Ford Motor Corporation had owned Volvo, and Geely bought it from Ford for about almost just under $2 billion in 2010. Ford also had owned Jaguar and Land Rover too, and sold both of those off to India's Tata Motors for about just under $2 billion in 2008. So the Chinese are really in the game. Geely also became a major shareholder in Germany's Mercedes-Benz, or Daimler AG, which is also Mercedes-Benz. And now they're pursuing some joint ventures. So the Chinese are really in the game on the auto industry. Even though we haven't seen their cars directly, we are seeing they are controlling interest in a lot of the global popular cars that we all drive or want to drive. Some of the complaints against the TNC is that they tend to disregard environmental and policies and perpetuate extreme income disparities and poverty across the global south as they exploit the labor force and resources. Actually, let me back up one here. Sorry about that. This chart really just shows you the number of global 500 companies and who controls what. And you can see China has 124, US 121, followed by Japan, France, Germany, and so forth. So you can see where most of the major companies which hold most of the major capital of the world actually reside. This just talks about a little bit of regarding internet providers and stuff in China. And China does uses advanced technology to pursue its core political interests, and it has certainly utilized cyber attacks, stealing information and technology from Gmail and other information from Chinese human rights activists and so forth. China does try to assert its sort of cyber sovereignty philosophy, which enforces strict cybersecurity laws that control governance of the internet within its borders. Then you also have other transnational activities that are hard to control, like in Niger Delta, Nigeria, millions of barrels of oil spilled over the last few years. So when you don't control the resource or control the infrastructure of the resource in another country, that creates a huge problem. And then when we talk about promotion and buying difficult and difficult in globalized marketplace. We're really talking about how countries seek to promote their own companies, or consumers looking to buy domestic products find it difficult to do so, particularly in an increasingly globalized marketplace where economic borders are often sometimes blurred. There's always this huge gray area, and so it creates a huge problem. 5 of the 8 top American car models in the annual 2009 Cars.com survey came from Japanese automaker Honda. Numerous models produced by U.S.-based companies don't qualify as domestic because they're assembled abroad with limited American-made parts. It's interesting how they'll tell you, buy America, but then most of it's not made in America. So some of the things that hinder development have a lot to do with the U.S. stock market, of course, plays a price in that. Certainly, so when the prices swing up or down, it certainly has a global impact on our ability to promote development. The escalation of the trade conflicts between China and the U.S. have sent markets downward, which has been a real problem. And of course, COVID-19 has certainly caused markets to lose considerable shares of their value. Excuse me. And then the IMF, the role of the IMF, the International Monetary Fund. The purpose, of course, is to promote cooperation on monetary policy and to stabilize currency exchange rates. That's the premise of the International Monetary Fund that was created during the Bretton Woods Conference after World War II. The purpose is also to assist countries attempting to balance their accounts and meet their outstanding obligations. It has extended interest-free assistance to low-income countries through the Poverty Reduction and Growth Trust that supports annual lending of about just under $2 billion to poor countries. Let's see. Excuse me. So then we look at the CPF, the Country Partnership Framework, which their aim is to zero in on conditions relating to the persistence of poverty and inequality. And so with that, they are, well, their goal is to work with these countries to provide fiscal management, enhance delivery of public services, encourage private sector development, and promote environmental sustainability. And then the Global Partnership for Social Accountability, basically the World Bank has incorporated specific targets and performance indicators to frame the activities meeting the 25 Millennial Development Goals. It's now working to advance the Sustainable Development Goals and initiatives to the Global Partnership for Social Accountability. And in that, some examples are like the African Development Bank's renewable energy technology venture that's happening in the Sudan right now. And then an initiative to subsidize the installation of solar-powered irrigation pumps to enhance productivity in agriculture. So there's cross-border highways linking Nigeria and Cameroon. So a lot of this is happening in Africa primarily, but also other parts of the world as well. We're almost done. Hang in here with me. I'm almost done. And then some of the things that are continue to hinder development. Of course, outstanding financial liabilities is always a problem. So having lower interest rates which have limited returns has been a real problem. This prompted insurers and pension funds and asset managers to incur greater risk to pursue opportunities promising higher yields. So it's a real problem in terms of when you talk about these outstanding liabilities and debts, which can actually bring down economies and then disrupt the global flow of financial capital. Also, how financial markets strive to maintain vibrancy. Like in 2019, the net private capital flows from emerging markets were estimated around 1.6 trillion, excuse me, 1.26 trillion, and they have been between 2000 and 2015. Those flows declined 1.1 trillion as investors tried to minimize their risk. So there's all kinds of things that can cause fluctuations in the market. Here's an example of how capital flows from 2013 to 2020, and you can see where the dips occurred and how the market recovered by within about 8 years. So you can see how the capital. Let me just digress here one moment. You can see here how the rate of capital flow changed over that period of time, and again, how the decline happened as a result of the investors not putting their money in the market, and that's why you see that dip that happens around 2015. Okay, so with that, that is the end of this chapter, and I went 36 minutes, but that's still better than an hour or 2 parts. Okay, thanks, you guys. I will see you for chapter 8, and we're almost there. So hang tough and keep working, okay? All right, thanks.